Hey, good afternoon, everyone. Again, it is wonderful to have all of you join us today for our quarterly portfolio update. A few housekeeping items that I'll go through real quickly before I pass it off to Jeff to start us off on the review. At first, you will notice that you are automatically on mute, but if by chance something happens and you become unmuted, if you could please mute yourself during the presentation, and that would be wonderful. There will be an opportunity to ask questions after Jeff's presentation. The presentation will probably be about 25 to 30 minutes, and then we'll have some time for some questions. With that, I will pass it off to Jeff to get us started.
Perfect. Thanks, Anissa. When we booked this, certainly didn't book the right day. Should have been on a rainy day. But for those who joined, I'm honored that you take the time to come out and listen to me talk about stock markets on such a beautiful day. This is something we wanted to do for quite a while. We've been talking about having this sort of update to be able to just sort of address how the portfolios are doing specifically. I know when we're doing all the stuff behind the scenes, a lot gets lost in the fold. So I like the idea of having these updates quarterly to kind of go over the positions, go over the performance, and talk sort of more nuts and bolts on what's happening in the accounts, and also talk about sort of what's happening in the world. So it's our first time running it. So bear with us as we sort of work through some of the kinks, but it's something that, I'm certainly hoping to do every quarter going forward, and hopefully everyone will be able to join next time. So like Anissa said, I'm going to go through. I've got sort of some stuff to talk about directly on the portfolios and sort of the positions that we hold. And then I'll talk about some of the what's happening in the economy, and then open up for questions on everything else going on in the world. So I'm going to start my PowerPoint here. Let me just make sure this works. We tried this out before and it seemed to, so bear with me one sec here. Should load up. One moment. Perfect. I'll flip forward here. So just sort of an overview again, and looking at where we're at. It's been an extremely good start to the year. Now the last few weeks have been a bit more challenging. I'll talk a bit about that in the economics part of the presentation, but overall, the beginning of this year has really been a continuation of last year, or the end of last year, where we've seen really strong growth in the equity markets, especially. The bond markets have been a bit weak to start this year. Ended 2023 really strong. I mean, people like to hate on bonds a lot, but the last quarter of 2023, sort of following the AGM that I did in September, that probably a lot of you were at, I was really talking about how bonds were really the way to go, given how low rates, or sorry, given how high rates were, and given how low bond prices were. So we did see an increase of about 10% in bond prices at the end of 2023. This year it's been a bit of a drag, but still like the space. I'll talk a bit about that. In our portfolios, we have Canadian equity, U.S. equity, international equity, fixed income bond investments, and looking at sort of where we're exceptionally doing well is in the Canadian equity side. We've just really kind of nailed it this year on our picks in the energy space, and in precious metals, and then in fixed income. So even though bonds have actually been negative this year as a whole, our bond portfolio, our fixed income portfolio has actually done pretty good. I'll talk about some of the areas that we've been weaker, and sort of how we're looking at that. And I guess the major thing that I sort of lead with all my portfolio conversations right now is, when you look at how we're doing, how our portfolio is doing compared to sort of the average in Canada. We're exceeding on a performance basis, and we're doing that with less risk. And I always say that that our goal here at Cree Capital is always to deliver as much return as possible with the least amount of risk as possible. And and when I look at our balanced portfolio right now, again, we're doing better than the average balance fund in Canada, and we're doing that with a significantly less amount of risk, less equity exposure, and so that's something that that's always the goal, and so we're certainly meeting that this quarter. And then I'll talk about sort of 2024, what we see and how we're positioned the portfolio now, and sort of where we're looking ahead. As a quick recap of where we're at, and this is as of the end of March, so it's about 18 days past now. But looking at the market total returns on the left side of the slide, I don't think I have a way of. Oh, I do. There you go, cursor. Perfect. So looking at the world global equities as a whole for the end of the quarter, up about 8%. Bonds, as I said, were down about -1%. And then commodities down at the commodities again, oil, energy very strong with some of the problems we're having in the Middle East. And then gold finally making a big showing. Now I'm going to talk mostly about our balanced portfolio. I know we have sort of the majority of our clients are in our balanced portfolio, which is like your traditional 60% equity, 40% fixed income mix. It's always difficult when you're presenting to a group of people that have different portfolios and different risk tolerances, recognizing that some folks have more conservative portfolios, some folks have more growth-oriented portfolios. Now, we own all the same stocks and all the same investments in all our portfolios. It's just sort of different weightings depending on what the risk tolerance is, and that's something certainly we can talk about if you have any questions about that after the presentation one-on-one. But I will be talking sort of about our balanced portfolio because that's sort of the one that is most used, and that's where sort of these numbers are coming from. So looking forward. So currently, and again, this applies to all the portfolios as far as our positioning compared to average. We're currently sitting at about 55% in equity. So 23% Canadian, 22 US, and 10 international. So only about sort of roughly 38% in sort of cash and fixed income. And that cash component is earning interest. So that's right now on cash, we're getting paid about 4.25%. So still pretty decent there. And then the gray piece, the other section is the alternative assets, which is our gold bullion piece. Breaking that down a bit further on the fixed income side, at sort of where we are in the individual fixed income investments, preferred shares up about 10%, or sorry, we have about 10% weighting, so that's a good chunk of our fixed income, and that's really where a lot of the performance has come from this year in our fixed income portfolio. Preferred shares have been just exceptionally good. Corporate bonds, government bonds. We don't have a lot of inflation-linked bonds anymore. Our thinking was, well, inflation's on its way back down, so we have a small component of floating rate bonds, and then cash and this VETFs is our Vanguard exchange traded funds. We have a small positioning in that in all of our portfolios as really a way to let us either add cash into our portfolio quickly, or if you call us up and say, hey, I need $10,000. That's something that we have that liquidity available in the portfolio. Now, looking at sort of the performance in those individual areas, this is sort of how we're looking year to date. So in our Canadian equity portfolio, we're up about 11%. Again, this is at the end of March, up close to 11%. U.S. equity, same, around 11%. International has been a bit of a struggle. International is tough because when you look at what we own internationally, we only have 3 stocks, so it's hard to really compare to a benchmark. We own Diageo, which is the world's biggest liquor company, L'Oreal, which is the world's biggest cosmetic company, and then Nestle, which is the world's biggest confectionery company. So we own those because there are these massive global brands that give us currency diversification. But when you have sort of all your eggs in a few baskets, and then you try to compare to how you're doing, you have quarters where things don't always line up with how the markets are doing. Gold bullion, 9.6%, just incredible, and it's interesting looking at. I'll just fast forward to this next slide here. This was from the AGM. I was talking about gold bullion, and the case I was making at the time was, we had this period from sort of 2020 to 2020, late 2023. This is going again back in September 2023, where gold hadn't really moved much, and yet we had all this inflation. And my thesis was okay. Gold's got to move. Like inflation is here, and I love gold anyway because it's we're always trying to reduce risk in the portfolios, and gold is it's a safe haven, meaning that it's an area of the it's an investment that tends to do well when everything else in the world is falling apart. So it's a great sort of insurance policy in the portfolio. When things go poorly, and again, when you can buy it when it's seemingly undervalued, all the better. So again, right back in September, gold was sitting at $1,900. It's at about 2,400 today, so it's up 20% in the last sort of 6 months, and it's just been a phenomenal asset. Looking at sort of the comparison of how we've done compared to the benchmarks. So again, in Canada, being up about 11% in our Canadian equities that we own compared to the TSX at the end of March, is up about 6.6. US again, sort of in line with US performance, thanks to having so much in the tech industry. International, like I said, we've fallen a bit behind there, and again, that's largely because when you look at the companies, like the sort of consumer product companies, both, like I said, Diageo, Nestle, L'Oreal in the international portfolio, companies like Nike in the U.S. portfolio. It's sort of these big global, sort of slower growth but very stalwart, strong companies have sort of been lagging in the last sort of 6 months, and it's really been those growth companies that have been driving market returns. And again, in fixed income, I'll just point out 3% was what we achieved in the fixed income portfolio. Pretty not an outstanding amount of return, but 3% in fixed income for 3 months is pretty great. You can do that every 3 months, then you're making 12% on bonds, which is awesome. And again, compared to the market, which is at about negative 1.3, the bond market, certainly feeling pretty good about that. Overall, looking at, and this is again the end of March, our average balance funds. So keeping in mind that we run individual portfolios for everybody. We try to keep them almost the same as possible, as close as we can. But on average, our balanced accounts were up about 7% for the first quarter, and if you compare that to sort of the average in Canada, about 5.1, again, that's about 2% of outperformance, and doing that with only 55% in equity, compared to most balanced funds that have sort of 60 to 65. So in large part due to the Canadian equity outperformance and to the performance in gold and to the outperformance in fixed income. I'm just going to go through the stocks here real quick in the interest of time. What I did is went into the individual portfolios and looked at the performance of the companies, and this is as of up to Tuesday, which is when I made this slide deck. So first off, point out that Capstone Copper has just been outstanding this year, thanks to Vic Dodiak, who's our portfolio manager of a lot of our Canadian basket names. Copper itself is up about 20%. So a lot of that is to do with just the metal moving. But a great sort of mid-sized Canadian company, very stable balance sheet, mines in sort of all stable jurisdictions at a time when really we see copper as just being increasing in demand with all the electrification and shortages that are and the difficulties of building new mines. It's just been a phenomenal return. All these energy names, MEG, Suncor, Topaz, again, as oil has rallied up, have been fantastic. National Bank, we've done our best for that one, but up 9%. Again, precious metals up 8%. And then what I've done is I highlighted this is as of Tuesday, the TSX in Canada up about 2.4. And so it sort of shows you sort of what, how our names have done compared to the index, the TSX. I guess the only thing to talk about would be BCE. It's one we continue to hold. It's down about 40% from its peak now. It's just been sort of on a downward slide for a while. Now, we didn't buy it at its peak. We bought it because it was cheap, and it's gotten a bit cheaper. The dividend currently is about 9%, which is ridiculous. And I'm reminded of, for those of you who had investments back in 2008 when Bank of Montreal and Royal Bank had those kind of dividends when their stock prices were down, and just the attractiveness of that. Now, there's nothing to say for sure that BC is going to keep paying 9%. But as far as I can tell, looking back through their history, they've never cut their dividend. So it means a lot to them to keep paying it, and so that's the hope that they will continue to. The U.S. portfolio, Walt Disney, probably my favorite company in the world, had a fantastic quarter thanks to been lagging the last couple of years, quite frankly. But good to see it up top on the quarter. Amazon, Google, Microsoft, all fantastic quarters. S&P 500 as a whole, again, great. Some of the struggles, again, Nike, I talked about, Estee Lauder, another sort of large global company, and Apple's kind of a surprise, being down 12% for the quarter. A lot of people, surprised by that one. And again, it's where we're seeing is these companies that have kind of maxed out or sort of saturated their growth, which is similar with some of the European names, which I'll switch to next here. When you look at companies like Diageo, L'Oreal, Nestle, these are the global leaders, and Apple is arguably the global leader. They're having some, their own issues and struggles with anti-competition and things like that. But you get so big, it becomes harder and harder to grow such a big thing. And so, we're really seeing money in the market right now shift towards growth names, and sort of away from these stalwart, huge, well-run, sort of safer businesses. And I think given where the market is right now, and I talked about that at the AGM as well, I feel comfortable in these kind of names. I feel comfortable, buying these kind of companies at a 20-30% discount, collecting the dividends. And again, it's not an all or nothing strategy. We don't put all of our money in companies like BCE and Apple. You own a bit of Amazon and a bit of Microsoft as well. So it's a balance of sort of growth-based companies and sort of the safe-based companies. And I'll just flip forward here, looking at the fixed income portfolio. So again, talking about preferred shares, our Royal Bank pref, actually, it just jumped up on Tuesday, as Royal Bank announced they'd be calling it at its $25 price, which was a bit of a surprise. It was trading around $23 on Monday, so a nice little jump up there from 23 to 25. And overall, this is a preferred share that we bought back in July last year at around, started buying it around sort of $18. So going from $18 to $25 for a fixed income bond investment's awesome. And all these preferred shares in general, the idea with preferreds, I mean, I've traded them now for 16 years. Bought them when they've been low, sold them when they've been high. They are getting a bit high now and starting to get near their peak. So, when this Royal Bank one gets called, we probably will just let that go and put the cash somewhere else. But it's just a great area where you can really, our group is sort of big enough to make a difference in the preferred share market, but not so big that we move the market. And so we can get really good pricing on preferred shares, and we can sort of, take advantage of that market. But we're still small enough that we can actually get the shares, because they can be kind of a liquid for larger pension funds. And again, it's been an area that's really been the leader of our growth in the fixed income space, and a lot of the reason why we're able to outperform last quarter. And again, looking at sort of the bond universe highlighted there, and again, this is as of Tuesday. So bonds now in Canada down about 4% for the year. So again, it's been a bit of a struggle. I'll talk a bit about that as I get to the economic slides. Government bonds, long-term bonds have again been a bit of a struggle too, but we still think that rates are coming down, and we're still going to hold there and enjoy the coupons. I just wanted to sort of highlight, because again, I just feel like I'm always defending bonds. I feel like everyone, just they've been bad for so many years, for like a few years now. So everybody just is kind of sick of them, and so I always point out that they're up 10% in the last quarter of 2023. They're paying really good coupons, right? So we're getting about 5% on average. There's a couple like the Manulife pref at 7, the Great West at 6.6. So they're paying very good dividends, very good interest. And again, the idea is, we do believe that rates are ultimately on their way back down. And then when that happens, there's 10 to 20% upside in the bond market still from where it is now. And so, it's an ability to be able to capture that upside, enjoy the dividend income that's there, and not have to just put all our money in stocks and sort of go on that roller coaster ride to try to make money for our investors. So flipping forward, sort of looking ahead at 2024, and again, if you have any questions on the portfolio, I'll be happy to talk about that at the end of the presentation. Just save those and we can go through them. But I just wanted to talk sort of briefly about the sort of get into a common question I have right now for a lot of people is, is now a good time to invest? I have this cash, I've been sitting on this, the market's at a high, what should I do? So I'll talk a bit about that. I'll talk a bit about sort of the economic situation and where things are at, with current interest rates and inflation and sort of the foreign exchange issues. I don't have slides on the U.S. election, the global conflict, whether that's in Europe or in the Middle East, or anything on like crypto or AI, but I get those questions all the time. So I put them up there, and if someone wants to ask them, go right ahead. So just looking at sort of the markets, as I mentioned, thought this is a pretty good chart. It kind of shows kind of the history of the last couple of years and where we're at. And so looking at the U.S., the S&P 500, really got back to its 2022 peak. The markets, if you remember, sort of hit a peak at the end of 2022 coming out of COVID. 2023 was a really crummy year. 2022 was a really crummy year. 2023 was a crummy year for most of it, but things got better at the end, and then this year's been off the races. So the U.S. market has expanded about 10% now from its previous peak. The Canadian market is basically right back to where Canadian and international markets are basically right back to their peak at the end of 2021. Emerging markets in China have been lagging, and thankfully we don't have a lot of those, so it hasn't really affected us too bad. But certainly when you get these markets returning back to these peaks, that's when folks sort of tend to ask, okay, well, we're at a high, maybe I should wait for it to pull back. And I guess I'll just say briefly on that, our job is, we try to be the best stewards of money we can, meaning, when the markets are high or when things feel toppy or feel like there's an increased level of risk because prices have gone up so much, of course we're going to shift money to be safer. Like that's sort of we're constantly shifting money, either increasing risk or decreasing risk, depending on sort of the way the world looks. But it's really, our goal to put money every day where it's best used. And, the whole idea of there's time to get in, there's time to not get in. If the answer is no, you shouldn't get in right now, you should wait, then, we should just sell and go to cash and just we should all wait, right? Like why leave money that's already in there? It doesn't make any sense. So, we treat every dollar that comes in, every dollar that we're managing, as what's the best purpose, what's the best thing we can do with it right now. And so my answer, and it's sometimes difficult to hear, but my answer to people is always, sure, there's opportunities where it's glaringly obvious that money should be added. When the market's down, 20, 30%, prices are low, of course, that's when you should be adding money. No one ever does because everyone's terrified, but that's when you should. But that's a whole other story. But it's this idea that markets always make new highs. There's this history we got, going back decades. There's of highs being beaten by highs, being beaten by highs, being beaten by highs. So I think there's good opportunity in a lot of the names that we own right now. Again, a lot of those companies that have been lagging in the equity portfolio, And I think that given where fixed income is right now, it's a great safe space to earn good yield and take advantage of rates coming down. Looking at the economy on the positive side, and sort of why markets have done so well the last 6 months, it certainly is this idea that, okay, rates are finally coming back down, or that's at least where they're going to be heading. Maybe not right away, but that's where they're heading. And also just really strong economic growth. So this is a chart of US GDP, and as you can see, it's sort of been on a straight line up. Really throughout 2023 and into 2024, currently sitting at about 3%, so above that sort of 2% potential. So in this sort of expansion period of the U.S. economy, which is so you expect strong stock markets tend to follow the economy, and so when you have economic numbers that are or the leading economic number being gross domestic product, at these elevated levels, of course, people are going to be interested in stocks. Portfolio managers are going to be allocated to equities, and things are going to be good. And we don't necessarily expect there to be a drastic change in GDP. But again, our portfolio is positioned right now as quite underweight in equity. Currently at about 55% in our balance model. Can be as much as 65. So call it 10% underweight from the maximum position in equity. And that is because, the markets have done really well the last 6 months. It's also because there is some things that do keep me up at night, and I'll talk about those a bit. One of them is manufacturing. So when you start to look at manufacturing over the last few months, we see this drop below 50. And this is the Purchasing Managers Index of manufacturing. The main idea is that when we've seen it drop below 50 in the past, going back over the last few decades, it's been indicative of a recession, and that's what these big gray bars are, is recessions that sort of followed. And you can see it's been dropping for probably about 6 months now. And again, this idea that, okay, there's a recession coming. We've been talking about that for a long time. Again, GDP still 3.1%, still in growth mode. But it's certainly worth taking note of, and it sort of raises a bit of a flag. Looking at unemployment, probably the other sort of thing that's, again, the unemployment rate in the U.S. is still at a sort of a historical low, 3.8%. So still very low unemployment. But it is starting to creep up a bit. And when you look at this ratio of job openings, the blue line, there was sort of 2 available jobs for every unemployed worker 6 months ago, and that's down to about 1.3. So we are starting to see signs of maybe the economy is starting to slow a bit, and the high interest rates are starting to take a bit of a toll. Speaking of interest rates, so this is a chart of the 10-year bond rate in the U.S. We've seen it creep up from 3%. This chart is a few weeks old, so it was getting near 4. It's about 4.6 now. So back to almost near where its peak was. And this is largely because of some concerns lately with inflation. Looking at U.S. inflation data, again, we've seen this massive drop down from sort of 9% inflation down to 3.2. So almost back in this sort of gray range, which is sort of the sweet spot of where the Federal Reserve wants to see rates when they're dropping them. I mean, last time we were in that range, rates were basically at 0. So we're getting close to that range now, which is the reason why we expect to see rates drop. But if you look at inflation over a 3-month period in the U.S., you see the spike up that came out a couple of weeks ago, a few weeks ago now, and again, that sort of there's some word in the market that, okay, maybe rates aren't going to drop quite as quickly as we'd hoped. Maybe there's still some persistent inflation in the market or in the economy, and so this idea that rates have sort of bounced back up and put some negative pressure on the market the last few weeks. Looking at Canada, one of our sort of other major theses in the portfolio is the idea that we really love the US dollar right now, and I wish that wasn't the case because traveling to the US is awesome and it's getting really expensive, and I live on the border and I go down there for gas and it's almost not worth it anymore. But we do expect the Canadian dollar to actually continue to weaken against the US dollar. When you look at unemployment growth in Canada, it's about double what we're seeing in the US. So that's indicative of sort of a weaker Canadian economy. And when you look at inflation in Canada, I guess this is good and bad. Good in the sense that we're not having the same inflation problems as the US with inflation increasing, but bad in the sense that maybe our economy is stalling out faster, in which case, rates are going to have to be cut faster in Canada, and we could see the currency drop. When you look at inflation in Canada, again, 1.3%, so firmly in that gray range in Canada, again, versus that sort of 4.3 over the 3-month period in the US. So again, weaker inflation data. And actually, when you look at year-over-year inflation in Canada, if you take out shelter, you take out housing, we're at only about 1% in Canada over the last year. So 2.8 overall in Canada, but shelter and housing prices have been a huge part of that. Looking at sort of what the interest rate expectations are for both the Bank of Canada in red and the US in blue. Again, both are sort of expected to start dropping rates within the next 3 months. We expect to see a cut, certainly as soon as June. Right now they're sort of seen doing it in parallel. What we expect is Canada might actually start dropping faster if the economy continues to look fragile. And again, if Canada starts dropping rates faster, we'd expect to see the Canadian dollar move firmly up. Again, this chart's a few weeks old. The Canadian dollar is getting close to that sort of 139 level right now, breaking out of this range it's been in for the last couple of years, bouncing out. But we could see it go up to like 140, 141 certainly if we do see rates drop. Sort of last slide, again, just looking at our overall positioning in the portfolio, really liking the US currency in the equity component. Emerging markets in China didn't talk about that much, but it's a really almost a negligible component of the portfolio. We have about 1.5% in emerging markets. And just this idea that overall we're sort of neutral on equities and bonds. And yeah, so I'll kind of pause there. That's more than 25 minutes, and I'll open it up to questions. Oh, you're muted, Anissa.
Thanks, Jeff. That was very informative. And as Jeff mentioned, we will now open it up for questions. And so if you notice on the top toolbar, there's a button that's got Q&A. If you can go ahead and type in your questions there, we will have Jeff answer them. And while you're thinking about some questions or have already questions and are putting them in that question and answer box, I'll pass it over to Zach, who's got some questions that we had received from clients and get him to ask some of those questions.
Thanks, Nisa. I think most of the questions that I had written down and maybe that were inquired by clients, Jeff probably kind of covered in his presentation, as I expected he would. Jeff, a question about sustained levels of inflation, if not higher, potentially impacting or reducing the potential for a decrease in interest rates. Do you foresee that happening kind of in the next little while?
I mean, I think it's inflation's such an interesting thing, and I can remember 4 years ago we were worried about deflation, and we were worried about aging demographics, and would we become the next Japan? And the market's always afraid of something. And it's once you kind of figure out what it is, then it's just tracking that, and it really that becomes the thing that everyone's focused on, and really what moves price. I think that in the US, especially when it comes to employment inflation and wage inflation, we could see some sustained pressure there, only because it becomes like a chicken and egg thing where, prices go up, and so wages have to go up, and wages go up so people can spend more out in restaurants and travel, and so prices go up, and then they need more money to afford it. And that's kind of the spiral that we're in, and that's why, rates were risen so quickly, was so that we could try to curb that before it became a big problem. I think that, the US is in a more, in some ways, in a more fortunate position, from an interest rate perspective, because mortgages there are, multi-decade. So people, as long as you don't sell your house, you can, people locked in and refinance low mortgage rates. So they're not being as affected in the US. So that becomes, I think, more of a challenge to bring inflation down, because people haven't slowed down their spending. Versus in Canada, when we have these shorter term mortgages, 5-year terms, where now people are starting to deal with them maturing and having to deal with these 5% plus rates. That becomes interest rates certainly become more of a concern in Canada. But I think that the cure for inflation is killing everybody's spending, and you kill everybody's spending by increasing rates. So there is a scenario where it could get out of hand, but I feel like I feel like if that was going to happen, it would have happened in 2022 or 2023, coming out of COVID, when there was so much cash on the sidelines, so much surplus savings. Whereas now it's really been spent through. So I think it's less of a concern now, and now it's just trying to find the right balance.
Very good, thank you. And jumping over to foreign exchange, where do you see the Canadian dollar kind of settling against the US dollar? I know you said it is going to continue to depreciate, especially if you tie that in with interest rates kind of dropping faster than the US dollar.
Yeah.
What is fair in this economy?
Our economists think it's going to go to about 69 cents. So 72 and a half today, roughly 72.6. So again, it's not a dramatic amount of change, but call it an extra, what's that, 4%, 5% or so from here. I mean, it would have to be a real big slowdown in the Canadian economy. A lot of people would have to leave after the latest budget, for it to go much lower than that. But I think, could we see a Canadian dollar at 65 cents? If there was a weakness in the economy globally and we saw oil prices come off, I think you could. But again, when you look at sort of all of our U.S. equity holdings, our U.S. bond holdings, our international equity holdings, we're roughly about half of our portfolio is weighted in U.S. currency. So that again has been a nice boost this year, continues to be a nice boost in performance. And it's just positioning for that expected scenario that we could see some continued weakness.
Thanks, Jeff. Anissa, that's basically all I had for questions.
Oh, you're muted again, Anissa.
There we go. Great, thanks, Zach. Does anyone in the audience have any questions? I know I haven't seen any pop up, but does anybody have any questions they'd like to ask Jeff?
You can find me offline. Yeah, and certainly, like, if anyone has any questions on anything, please, I can certainly send out the slide deck. This might not be the best format for asking questions. It's always hard to see, do we open it up to everybody to ask? Do we do it by text? Maybe it's easier next time just to do it and have people be able to unmute themselves and ask questions. That might be more comfortable. We're figuring it out, but I'd be curious to get some feedback. Is this stuff really boring? Would you like me to talk more about certain topics? I'm kind of willing to build this out to what the most people want to see. But I again, really, I always feel like we do so much sort of behind the scenes and everything we're doing with our analyzing portfolios and equities, and trying to walk the tightrope through the crazy world that we live in, and try to keep the returns steady and keep the big number on the portfolio statements stable. But so I love this opportunity to be able to kind of talk a bit about what we did and have this forum to do it. I also love the accountability part for us to be able to say, okay, here's where we're doing well. Here's where things aren't going so well and why. And so again, just having this format, having this video available for people to be able to send out clips to if you have questions on certain things. Yeah.
Okay, great. Thanks, Jeff. And we actually got a comment saying it's not boring. It was a nice update and prediction, and thank you. So,
All right. You're
yeah.
welcome.
And again, thank you everyone for joining us this afternoon. And as Jeff mentioned, we are going to be doing these every quarter. But then, of course, between now and then, you know where to find us. And even after this, if things come up, questions come up, please feel free to reach out to any of us and we'll get the answers for you.
Awesome. Thanks, everybody.
Thank you, everyone. Take care.